In April 1992, the Indian stock market suffered a catastrophic crash. 5,000 crore rupees, roughly $3 billion, was embezzled from the system, wiping out the life savings of millions of retail investors in a matter of days. The architect of this devastation was Harshad Mehta, but he didn't begin his career as a wealthy financier. In the late 1970s, he was an ordinary clerk processing insurance claims for just 600 rupees a month. He managed to talk his way into the Bombay Stock Exchange as a jobber, a middleman who matches buyers and sellers. Mehta relied on sharp instincts to navigate the yelling and chaos of the trading ring, already dreaming of becoming a dominant market maker. To truly control the market, Mehta required a pool of capital far larger than anything available to a typical broker. He soon realized that the massive sums he needed were trapped within the Indian banking system. By 1991, India was undergoing significant financial reforms. The government was applying immense pressure on national banks to show high efficiency and demonstrate higher profitability for the first time. A major obstacle stood in their way. Rigid regulations from the Reserve Bank of India forced these banks to lock up a massive portion of their deposits in low-yielding government bonds. This created a sector-wide state of desperation. Banks were cash-starved and heavily regulated, leaving Treasury officials eager for any loophole that could artificially boost their profit margins and help them meet their new targets. The conditions were ideal for exploitation. Mehta possessed the market ambition, and the banks possessed a desperate, off-the-books need for liquidity. To manage their cash flow, banks utilized the ready forward deal. In this system, a cash-poor bank would borrow short-term funds from a cash-rich bank, using its government bonds as collateral. A logistical problem existed. Moving physical bond certificates across the country using the manual public debt office was far too slow for modern banking. The banks created a fatal workaround. Instead of moving the actual bonds, the borrowing bank simply issued a bank receipt, or BR. It was a simple piece of paper acting as an unverified IOU, promising that the securities were being held on the borrower's behalf. A multi-billion-dollar financial network had effectively stopped verifying its physical assets, replacing collateral with blind, paper-based trust. Legally, stockbrokers were only supposed to act as intermediaries, introducing the lending and borrowing banks to each other and taking a small commission for the service. Mehta convinced lending banks to write checks directly to him, promising bank receipts later. This created a massive cash float. Mehta used these funds to buy enormous blocks of shares, pump their prices, and sell for massive profit before returning the original cash. He scaled the operation by colluding with corrupt officials at smaller institutions, like the Bank of Karad. Together, they printed fake bank receipts that had no physical bonds backing them whatsoever. Major banks accepted these counterfeit receipts without checking the vaults. They were blinded by the high returns Mehta provided, which allowed them to hide their own internal portfolio losses. Mehta's artificial liquidity caused the Sensex to quadruple in a single year. Individual stocks, like Associated Cement Company, rocketed from 200 rupees to 9,000 rupees. Mehta began to flaunt his success, moving into a 15,000-square-foot penthouse and publicizing his fleet of luxury cars, which included a fully imported Lexus sedan. He had effectively turned the entire Indian banking system into a personal source of liquidity, built entirely on a foundation of counterfeit trust. The scheme began to unravel in April 1992. Financial journalist Sucheta Dalal investigated the massive, unaccounted-for cash flows in the system and exposed the billions in missing bank funds. The market suffered an immediate, catastrophic crash as artificial liquidity dried up. Elite banks realized they were holding nothing but worthless fake bank receipts. The crash destroyed the life savings of millions who had unthinkingly followed the big bull's lead. The collapse exposed a system that was structurally hollow, operating without any meaningful regulatory oversight. Following his arrest, Mehta was summoned to testify before a joint parliamentary committee. In a characteristically bold move, he demanded to present a slide deck to defend his actions. This slide from his presentation captures his primary defense. He argued he was being denied a fair chance to prove his innocence, claiming he was handicapped because the government had sealed his offices and seized all his records. He argued that natural justice demanded he be given access to his books. He told the committee that without his staff and records, he was being set up as a scapegoat by a panicked government. His ultimate deflection was to blame the government. This slide shows him citing the genesis of the scam as the government's own regulations, which he claimed forced desperate banks to seek out unconventional and risky stock market investments. Harshad Mehta faced years of criminal trials until his death, but his actions forced permanent change. The fallout led India to abandon its archaic paper ledgers in favor of the digitized, heavily regulated financial system of today. Harshad Mehta's exploitation of the system's deepest flaws forced the country to finally abandon its broken infrastructure and build the modern, digitized markets of today.